If you're a senior woman living on a fixed income, struggling to make ends meet, listen to me carefully. There is one completely legal tax strategy that most older women have never even heard of, and it could save you thousands of dollars. I've helped countless clients discover this. And once they do, they finally breathe again. Stay with me to the end. I'll break it all down in plain English and tell you exactly how to do it. But before we get started, please hit that like button, subscribe, and in the comments, let me know. Have you ever felt overwhelmed by taxes in retirement? Let's talk about it. Part 1, the problem no one talks about. Let's start with a hard truth. For millions of older women in retirement, the biggest financial headache isn't the cost of groceries or medications or even rent. It's taxes. And no one ever warned you about this, did they? You were told to save for retirement, to contribute to your IRA, to invest a little when you could, and maybe, if you were lucky, to expect a modest Social Security benefit. But what you weren't told was that all those good financial choices, done with discipline and care, can actually come back to haunt you in the form of surprise tax bills. Let me paint the picture. You're 72 years old, living on a fixed income. You don't live extravagantly. Maybe you drive a modest car. Your mortgage is paid off, or mostly. You don't dine out often, and you budget carefully. Then tax season hits. You find out your Social Security is taxable. Yes, the money you already paid into for decades. You find out that because of your modest retirement savings, you're forced to take what's called a required minimum distribution, RMD, from your IRA, even if you don't need the money. And that extra income, it bumps you into a higher tax bracket. It raises your Medicare premiums. It may even cause more of your Social Security to be taxed. It feels like you're being punished for doing the right thing. And here's the kicker. Most senior women don't even realize this is happening until the damage is done. The IRS doesn't send you a warning letter that says, "Hey, this RMD is going to trigger taxes you weren't expecting." Instead, it quietly chips away at your hard-earned savings. And for those already on the edge, those caring for a spouse with health issues or helping adult children financially, it can be devastating. That's the problem we're facing, and I want to help you change that. Part 2, why the system is stacked against senior women. Now, let's talk about the elephant in the room, the one the tax code refuses to acknowledge. Women, especially older women, often face a completely different financial reality than men. You see, the tax system is built around assumptions that don't reflect the lives most senior women have actually lived. Many of you spent years, sometimes decades, out of the paid workforce to raise children, care for aging parents, or support your husband's career. That choice, while noble and necessary, often resulted in lower lifetime earnings. And what does that mean? Smaller pensions, smaller Social Security checks, less accumulated super or retirement savings. But then comes the cruel twist. Even with your limited income, you're taxed just as heavily, sometimes more, than someone who earned more their entire life. If you're widowed or divorced, the problem is worse. After the first year of widowhood, you lose access to married filing jointly tax rates. That means your tax bracket can jump even if your income stays the same. Picture this. 1 year, you're taxed as part of a couple. The next year, you're alone, but the IRS treats you like your income doubled. I've seen cases where a woman's taxable income didn't change one bit, but she ended up paying thousands more in taxes simply because of her filing status. Then add in rising healthcare costs, home maintenance, inflation, and even caregiving expenses, most of which aren't deductible, and you've got a system that quietly squeezes women in retirement. It's not just unfair, it's unsustainable. And yet most financial advisors, CPAs, and even lawyers don't tailor their advice specifically for senior women. They give the same cookie-cutter strategies to everyone. But here's the truth. You need a strategy that fits your story. And that's exactly why I want to share this next part with you. Part 3. The one tax trick most senior women never use. This is where things turn around. Because while the tax system has its flaws, it also has a few gifts tucked inside. Loopholes, if you will, that are 100% legal and wildly underused. And one of the most powerful ones for older women is called the Qualified Charitable Distribution, or QCD. Now, I know just hearing the term Qualified Charitable Distribution might make your eyes glaze over. But stay with me. If you're over 70 and a half and you have a traditional IRA, you could be sitting on a tax-saving gold mine. Here's how it works. Instead of taking your full required minimum distribution RMD and getting taxed on it, you can choose to send up to $100,000 directly from your IRA to a qualified charity. And when I say directly, I mean it must go straight from the IRA to the charity. You can't touch it. The IRS rewards you for doing this in 3 huge ways. That money does not count as taxable income. It satisfies your RMD, so you're still meeting the legal requirement. It doesn't trigger other tax dominoes, like higher Medicare premiums or taxation of your Social Security. Think about it. You already want to give to your church or the animal shelter or a cancer foundation. You probably already do. But if you're giving out of your checking account after you've already paid income tax on your IRA withdrawals, you're missing out. With a QCD, you're donating with pre-tax dollars, fulfilling your legal requirements, and keeping your taxable income lower, all in one elegant move. Most people don't know this. Even fewer actually use it, but the ones who do, they often save thousands every year. And over the course of a 10 or 15-year retirement. That adds up to real money. Part 4. Why this works so well for older women. So why is this strategy especially powerful for women in retirement? Because unlike many tax-saving strategies, like itemizing deductions or investing in complex real estate structures, a QCD is simple, direct, and doesn't require you to be wealthy. It works particularly well for women who give regularly to charity or church, women whose RMDs push them into a higher tax bracket, women who live alone and are taxed as single filers, women whose Medicare premiums have jumped unexpectedly. Let me give you an example. Jane is 74 years old. She has a modest IRA with $250,000 in it. Her RMD this year is $9,500. She normally donates $5,000 per year to her church. Without a QCD, she withdraws $9,500 from her IRA, pays income tax on all $9,500, then donates $5,000 to the church. With a QCD, she instructs her IRA custodian to send $5,000 directly to the church. That $5,000 satisfies part of her RMD and isn't taxed at all. Her taxable income drops by $5,000. Her Medicare premiums stay lower, and she still supports her faith community just like she always has. And here's the real secret. Even women who don't itemize their deductions, which is most of us now after the standard deduction was raised, can still benefit from this. Because QCDs don't require itemization. You get the full benefit whether or not you file Schedule A. In fact, the QCD is one of the few remaining tax benefits available to retirees that is white heavy checkmark simple, white heavy checkmark legal, white heavy checkmark, and effective. You don't need a financial degree. You don't need a high-priced accountant. You just need someone to tell you it exists. And now you know. Part 5. How to actually do it step by step. Now that you know how powerful a qualified charitable distribution QCD can be, you're probably wondering, how do I actually set one up? What do I have to do? Don't worry. I'm going to walk you through it step by step. This is something you can do without needing a room full of lawyers or a $1,000 accountant. Ready? Let's break it down. White heavy checkmark step 1. Confirm you're old enough. You must be at least 70.5 years old. Not 70, not 71. That half a year matters. The rule is specific. If you're not sure when you turned 70.5, there are online calculators, or your IRA custodian can tell you. If you're under that age, unfortunately, you're not eligible for a QCD just yet. But once you hit that mark, the door opens. White heavy checkmark step 2. Make sure you have a traditional IRA. This strategy only works with traditional IRAs, not 401(k)s, not Roth IRAs. If you have a 401(k), you may be able to roll it into a traditional IRA, which would open the door for QCDs. This process is legal, but should be done carefully with guidance to avoid unexpected taxes or penalties. White heavy checkmark step 3. Choose a qualified charity. The IRS only allows QCDs to be sent to qualified 501(c)(3) charities. These are typically churches, nonprofit hospitals, animal shelters, veterans groups, disaster relief funds, and so on. But not private foundations, donor-advised funds, or political organizations. If you're unsure, ask the charity to confirm their tax-exempt status, or check their EIN online through the IRS database. White heavy checkmark step 4. Call your IRA custodian. This is the most important part. The distribution must go directly from your IRA to the charity. You cannot take the money into your own hands first. If you do, it becomes taxable income, and the QCD benefit is lost. Every financial institution is different, but here's what you typically need to do. Call them and say, "I'd like to make a qualified charitable distribution." Tell them the amount. Give them the charity's full name, address, and possibly EIN number. Confirm they'll send the check directly to the charity on your behalf. White heavy checkmark step 5. Get a written acknowledgement. After the charity receives your gift, they should send you a letter confirming the donation. This is important for your records and your taxes. Keep it with your tax documents. Even though the QCD won't be reported as income, your tax preparer will still need to report that the RMD was satisfied by a qualified charitable distribution. White heavy checkmark step 6. Report it correctly on your tax return. Here's where things get tricky. When you get your Form 1099 are for IRA distributions, it won't say that part of it was a QCD. It just shows the total distribution. That means it's up to you or your tax preparer to indicate on your return that part of it was a QCD and therefore non-taxable. If you use tax software, look for the QCD checkbox. If you use a CPA, tell them in advance. Do not assume they'll know. Part 6. Common mistakes to avoid. Now that you know what to do, let's talk about what not to do. I can't tell you how many times I've seen older women lose out on thousands in tax savings. Not because the QCD didn't work, but because of small mistakes. Let's walk through the biggest ones so you can avoid them. Crossmark mistake 1. Taking the money yourself first. This is the most common error. If you withdraw the money from your IRA and then turn around and donate it, even the same day, it does not count as a QCD. You've already triggered a taxable event. The damage is done. The funds must go directly from your IRA to the charity. No exceptions. Crossmark mistake 2. Using the wrong type of account. Many retirees have 401(k)s or Roth IRAs. Neither of those accounts qualify for QCDs. You need a traditional IRA. If you only have a 401(k), speak to a financial advisor about rolling it into a traditional IRA without creating a tax event that may unlock the door to QCD benefits. Crossmark mistake 3. Missing the deadline. QCDs only count in the calendar year they're made. If you wanted to apply for this year, the funds must clear before December 31st. Not postmarked, not requested, actually cleared. If you wait until the last week of December, you're playing with fire. Don't procrastinate. plan ahead. Cross-mark mistake 4. Choosing the wrong charity. Not every cause qualifies. Make sure your donation is going to a recognized 501(c)(3) charity. Political groups, GoFundMe pages, and certain private foundations don't qualify. Always double-check the IRS list or ask the organization directly. Cross-mark mistake 5. Forgetting to inform your tax preparer. If your CPA doesn't know you made a QCD, they may accidentally report your full IRA distribution as income. That could raise your tax bill by thousands. It's up to you to tell them this portion was a qualified charitable distribution. Here's the confirmation letter from the charity. Part 7. Bonus tip for widowed or single women. Now, if you're widowed or single, I want you to pay especially close attention here. There's a hidden tax trap that hits women living alone harder than just about anyone else. It's what we call the single filing penalty. You may not realize this, but once you lose your spouse, whether through death or divorce, your tax rates change dramatically. In many cases, you'll move into a higher tax bracket, even if your income stays exactly the same. And here's the kicker. If you have a traditional IRA and are forced to take RMDs, those extra dollars can cause higher income tax, higher Medicare premiums, especially Part B and Part D, more of your Social Security being taxed, reduced eligibility for state programs or assistance. All of this hits just because your filing status changed, not because your lifestyle did. That's why the QCD is so powerful for single and widowed women. Let me give you an example. Mary is 73 and recently widowed. Her RMD this year is $12,000. She also receives $18,000 from Social Security and a small pension. Without a QCD, her total taxable income may push her into a higher bracket, raise her Medicare premiums, and cause 85% of her Social Security to be taxed. But if she uses a QCD to donate $8,000 to her local church, that $8,000 is removed from her taxable income. It may keep her in a lower bracket. It may reduce her Medicare premiums. It may even keep some of her Social Security untaxed entirely. That's the power of knowing the system and using it to your advantage. Ladies, being a widow doesn't mean you should pay more. It means you need to be smarter with your strategies. And now you can be